Imagine a high-stakes poker game where the world economy hangs in the balance, and the players are powerful financial institutions and government leaders. This was the scene during the frantic negotiations to save Lehman Brothers in September of 2008. Everyone knew the stakes were incredibly high, with fears of a global financial meltdown looming. The core truth is that there were no successful bailout terms for Lehman Brothers, as the negotiations ultimately failed. While other institutions like Bear Stearns and IG received government assistance, Lehman Brothers did not secure a deal that satisfied all parties. This failure led directly to its bankruptcy filing, a pivotal moment in the 2008 financial crisis. The primary reason these negotiations collapsed was a fundamental disagreement over who would bear the substantial losses from Lehman's troubled assets, particularly its vast holdings of mortgage-backed securities. The United States Treasury and Federal Reserve insisted on a private sector solution, meaning they wanted another bank to acquire Lehman without significant government capital injection or guarantees. Potential buyers, such as Bank of America and Barclays, demanded extensive government backing to cover potential losses, fearing that absorbing Lehman's toxic assets would destabilize their own balance sheets. Neither side was willing to meet the other's terms, creating an intractable deadlock. In such dire circumstances, a successful bailout typically requires a clear path for private acquisition, coupled with limited, precisely defined government support to stabilize markets and prevent systemic collapse. This support often involves loan facilities, asset guarantees, or direct capital injections, provided there is a credible business plan and a willing private buyer to share the risk. The lack of a clear legal framework and precedent for such a large-scale intervention at that specific moment also complicated the government's ability to act decisively without specific legislative authority. This situation highlighted the concept of moral hazard, where a bailout might encourage reckless behavior by other firms in the future. Policymakers wrestled with the tension between preventing a financial catastrophe and avoiding setting a precedent that government would always step in. Discussions also involved the idea of creating a bad bank, a separate entity to absorb troubled assets, though this was not implemented for Lehman. The collapse also forced a reevaluation of what it means for an institution to be considered too big to fail, prompting significant regulatory reforms in the years that followed. The inability to agree on terms for Lehman Brothers' rescue underscored the profound challenges of managing a systemic financial crisis. It demonstrated the limits of government intervention without appropriate legal tools, and it revealed the deep distrust among financial institutions regarding the true value of each other's assets. Ultimately, the failed negotiations became a powerful catalyst for reshaping global financial regulation, aiming to prevent such a catastrophic collapse from ever happening again.